All right, let's talk about GLD. For millions of people, it's the easiest, most popular way to get exposure to gold. But here's the big question. When you buy a share of it, are you actually buying gold? Well, the answer is a lot more complicated and way more interesting than you might think.
So let's just jump right in with the most important question of all. You go on your brokerage account, you type in GLD, you click buy. What did you just get? I mean, is it a little piece of a gold bar somewhere with your name on it, or is it something else entirely? You know, to really get the answer, we have to unpack what some people call the gold illusion at the very heart of GLD. It's an absolutely brilliant financial product, for sure, but it's built on a legal distinction that catches a lot of investors by surprise.
Okay, so here's the reality. You are not buying a piece of a gold bar. What you're actually buying is a share in a trust, and it's that trust that owns the gold. This legal layer, this separation, is the absolute key to the whole thing. It's what makes GLD work so smoothly, but it's also where all the confusion really begins.
So if you don't own the gold directly, then who does? And maybe more importantly, is the gold even there? This is probably the #1 question from skeptics, and the answer, well, it takes us deep inside the super high security world of the London bullion market.
Oh, the gold is very, very real. It's stored securely in HSBC's vault in London. Now, while HSBC is the main guardian, the fund can also use other banks, like the Bank of England, as what they call sub-custodians. And you can forget about little gold coins. We're talking about huge London good delivery bars. This is the global standard for serious gold trading.
And when I say huge, I mean huge. Each one of these bars weighs about 400 troy ounces. Just to put that in perspective, depending on the price of gold, a single bar can be worth over $900,000. Yeah, this is not something you're going to stash in your safe at home. This is wealth on an industrial scale.
So, to put all those "is the gold really there" questions to bed, the entire holding is physically audited twice a year. Auditors literally go into the vaults, they do physical counts of the bars, and they check the serial numbers against the trust's official list to make sure everything matches up.
Okay, so how does this giant pile of gold get magically turned into shares that you and I can buy and sell on the stock market every single day? It's a pretty fascinating piece of financial machinery.
Now, this right here is the absolute key to how GLD works. New shares are not created with cash. They're created with physical gold. A huge institution, what's called an authorized participant, delivers actual gold bars to the vault. In exchange, the trust creates a brand new block of GLD shares for them to sell out on the open market. This is the mechanism that ensures every share is actually backed by real metal.
And this brings us to a really crucial distinction: allocated versus unallocated gold. So once that gold is in the vault for GLD, it has to become allocated. That means specific, numbered bars are set aside just for GLD shareholders. It's your gold. It's different from unallocated gold, which is more like just a general IOU from a bank. This is so important because it means the bank can't lend out or play with the trust's gold. And now we get to the most surprising and I think the most important part of GLD's design. This is the part that honestly most long-term investors completely miss.
Look, like any fund, GLD has to keep the lights on. It has costs. You've got management fees, you have to pay for storing and insuring billions of dollars worth of gold, and that all adds up to about 0.40% per year. But wait a second, that creates a huge paradox, right? The GLD trust holds only one thing: gold. And gold just sits there. It doesn't pay you a dividend, it doesn't earn any interest. So how in the world does the fund pay its bills? Where does the money come from?
The answer is simple, and honestly a little shocking. The fund pays its bills by selling its own assets. Every single day, a tiny fraction of the trust's gold is sold off just to cover the operating costs.
And here's what that looks like over time. Because the fund is constantly selling a little bit of gold to pay those fees, each share you own represents a slowly but surely shrinking amount of physical metal. When GLD first launched, one share was exactly 1/10 of an ounce of gold. Today, it's quite a bit less. This whole phenomenon has a name: structural decay.
The math here is just unavoidable. Because of that expense ratio, GLD is literally guaranteed to underperform the actual price of gold over any long period of time. Now, that's not a flaw, it's not a sign of bad management, it's just how the machine is built.
Okay, so let's shift gears from that slow decay to a more sudden risk. Let's look at something buried deep in the fund's legal documents that critics just love to point to: the sub-custodian loophole.
Now, if you're someone who holds GLD as a kind of catastrophe insurance, this is the fine print you absolutely need to know. The prospectus says they can use those sub-custodians we talked about. But here's the catch. The main custodian, HSBC, has very limited liability for what they do. So let's imagine a major financial crisis. If a sub-custodian goes bankrupt while holding the trust's gold, your share doesn't give you a right to the metal. It leaves you with a paper claim against a failed bank. Not exactly the hard asset you thought you had, right?
Now, the market eventually caught on to this gold bleed from the expense ratio. They realized it was a real problem for long-term investors. And that's what led to the creation of a newer and, frankly, cheaper alternative.
And that alternative is GLDM, the mini shares version of the fund. It was launched with a much lower expense ratio, around 0.10%, and that means the gold bleed is a lot slower. So this has basically created a clear choice for investors. The original GLD, with its massive trading volume, is perfect for short-term traders. But for long-term buy and hold investors who really want to minimize that structural decay, well, GLDM is the more logical choice.
You know, when you boil it all down, there's a quote that just perfectly summarizes the real nature of GLD. It is a fund that pays for its own existence by slowly melting away its core asset. That really says it all.
So what's the final verdict here? Is GLD good or bad? The thing is, it's not about that. It's about knowing what tool you're actually using. For a trader who needs instant liquidity to make a quick bet on gold's price, it's a fantastic tool. But as a permanent store of wealth that's going to perfectly preserve your claim on a specific amount of gold forever, well, as we've seen, that's just not what it was built for. And understanding that difference, that's the real key to being a smart investor.